Problem 19-32. We're going to complete a job cost record similar to this one, which is just a screenshot from our PowerPoint. And we're going to record direct materials, direct labor, and manufacturing overhead for this job. And then we're going to do the journal entries, and then we will sell the product and also record the sale in the journal. So again, this is a screenshot of the review of costs moving through a manufacturer. So let's see what's going on here. So Kai Technology manufactures DVDs for computer software and entertainment companies. Kai uses job order costing. So we're doing jobs that are unique. On April 2nd, Kai began production of 6,000 DVDs, job 423. So notice we're going to be doing the job cost record for job number 423. 4 Paradigm pictures for $1.20 sales price per DVD. So we're going to sell them for $1.20 per DVD, and we have to figure out, well, how much did these DVDs cost us per DVD? So Kai promised to deliver the DVDs to Paradigm by April 5th. Kai incurred the following direct costs. So here are our direct costs. We've got the direct labor and the materials. Requirement 1. Prepare a job cost record for job 423. Calculate the predetermined overhead allocation rate, round to 2 decimals, then allocate manufacturing overhead to the job. Similar to what we did over here for the double neck guitar for Jimmy Page of Led Zeppelin. Alright, so we're set to begin. So the first thing we have to do, similar to what we did here, we added up the direct materials and came up with direct material costs of $275. So what we're going to do is we're going to add up 341 plus 725 plus 135 gives us direct materials of $1,201. Next, we're going to add up the direct labor. This one's easy. We're going to take 160 plus 300. That gives us $460. And that's, of course, people who are working directly. That's the wages for the people working directly on this DVD job. And then, this is where it gets a little more complicated. We need to calculate manufacturing overhead. First of all, let's figure out what the date is. The date that this job was completed, I believe, is found in here. So this job, 423, was completed and shipped on April 3rd. So now we need to calculate the rate for the manufacturing overhead. So here is another slide from the PowerPoint. So the first step is before the period, the company needs to calculate predetermined overhead allocation rate. And the way they do it, they take the total estimated overhead costs, which is right here, $574,000, divided by the total estimated quantity of the overhead allocation base. So what they do for the bottom part is they estimate the direct labor costs. So we're going to take 574,000 divided by 410,000. And then I've done this in Excel. So similar to this, I've got total estimated overhead costs divided by total estimated quantity of the overhead allocation base. So the overhead estimated overhead costs are 574, so I've placed that on top. And the overhead allocation base is direct costs. And they expect the direct costs to be 410. So we're going to take 574 divided by 410, which I've done here. And that gives us $1.40 or 140%, whichever way you want to think about it. So I'm going to place this 1.4 or 140% in here. So what that means is for every dollar of direct labor cost, and notice in this screenshot or this data table, the bottom part is estimated direct labor costs. So this total estimated quantity of the overhead allocation base is direct labor costs. So what it's saying is for every dollar of direct labor cost, we need to have $1.40 or 140% of manufacturing overhead applied to that job. So what I need to do is take 460 times 140%. 460 times 1.4 equals 644. So that's the amount of overhead that's going to be allocated to this job. So now what we're going to do is just summarize the cost. I'm going to take the 1201 direct materials, I'm going to add the $460 of direct labor, where did it go? Now it's down here. I don't like that. There we go. I'm going to take the $460 of direct labor and then the $644 of manufacturing overhead. That's things like indirect labor, plant depreciation, plant utilities, plant insurance use, plant property taxes, and indirect materials like glue, whatever it is for manufacturing DVDs. Now I'm going to add these up. 1201 plus 460 plus 644 gives us a total cost of $2,305. So that was for 6,000 DVDs. So we need to calculate the cost per DVD. And I've done that in Excel too. So the cost per DVD is just take the total job cost, which we calculated right here, 2305, divide by the number of DVDs, 6,000, gives us 0.3841666666. And of course we had to round that to the nearest penny, and that gives us 38 cents per DVD. 0.38. So remember, the DVDs cost us 38 cents per DVD to make, and we're going to sell them for $1.20 each. So that's a pretty good markup. I wouldn't mind being in that business. Journalize in summary form the requisition of direct materials and the assignment of direct labor and the allocation of manufacturing overhead. So for these three costs, we're going to now do the journal entries for them. So the way we do that is we need to start with direct materials. So when we ordered these direct materials to put on the job, it increases. Let me go back over here. So what happens is when we buy raw materials, this account, raw materials inventory, increases on the left side. But when we take the DVD raw materials out of this account, we then increase work in process. So work in process is going to be our debit account because we have to list debits before credits. So work in process is first, and the amount is 1201, copy and paste. And then what happens is we have to take the DVD raw materials out of the raw materials, so this account is going to be credited. Raw materials inventory. Next, journalize the use of direct labor. And it's reminding you that the wages are not yet paid. So we're not going to lower cash, we'll increase wages payable. So when we're journalizing this direct labor costs, we have to increase this job, which is in process. So we have to increase the work in process inventory account. How do we increase it? On the left side. So work in process is increasing by $460. Then we have to increase wages payable because we will pay those people or that person later. Next, journalize the allocation of overhead to job 423. So this $644, the manufacturing overhead, so we know the debit and credit. So as a reminder how manufacturing overhead works, it's a temporary equity account treated like an expense, so it increases on the left side. So when we had the actual indirect labor, actual manufacturing overhead costs, we increased the account over here and we pooled them together, and then when jobs are completed we remove some of that and assign it to the job. So when we remove this 644 from manufacturing overhead, we decrease that account and then we increase the work in process account. So remember, for manufacturing overhead, it's debited when there's actual costs, but it's credited when costs are allocated to jobs based on the job's size. In this case, the job size is based on the amount of direct labor cost. Anyway, so we're going to increase work in process, and we're going to lower the manufacturing overhead account. And then requirement 3, journalize completion of the job and the sale. So begin by preparing the journal entry to show the completion of the job. So when we were working on the job, it resided in the work in process, but once it's completed, we have to lower this account and it goes to the finished goods account. So the finished goods account is going to increase on the left side, and that's the debit account, so we have to list that first. So finished goods is increasing, and the amount it increased by is the cost of the job. It's $23.05, which if you added up these, that's how much $23.05 is. It's just adding these three up. And then we need to lower work in process. And then we're almost done. Next, journalize the revenue portion of the sale. So it says up here we sold the DVDs on account, so we're not getting cash, we're getting AR. So AR is increasing, therefore that has to be the debit. How much did we sell them for? $1.20 times the 6,000 DVDs. 6,000 times 1.2. I could have done that in my head. So $7,200. So I need to increase sales revenue. Remember, this says just journalize the revenue portion. We'll do COGS in the next section. And cost of goods sold is increasing by the cost of that job. So remember, once we sell a finished good, we have to remove it from the finished goods account and place it or increase the cost of goods sold account. So that's the debit account, COGS. And the amount that we are debiting is the cost of the job, which is right here. Copy and paste, which is also right here. So of course, when we sell that job, we have to lower the finished goods inventory because we can no longer sell that because it's already been sold. So we need to do the reverse of this. Excuse me. We need to do the reverse of this. So we increase finished goods, but now that the good has been sold, we have to decrease it. So that's why I'm crediting finished goods. And that's it.